Dear guests, good afternoon, and welcome to the third webinar of Cluster Act project, project financed with the ASME and the DMFF funds, and tailored to support investments and to connect SMEs enterprises with investors. Today we will focus the investment process and the selection of the business opportunities, and we will have with us Giovanni Fusaro from IFI and Andrea Odille Bosio from IBAN Association, that I'm welcoming and thanking for their availability to host this webinar. We will have a first description and part that will deepen the topic that we will listen and see today. And during this part, we will have the possibility to use the application to send eventually questions to the speakers that we will review at the end. So I'm just welcoming again the speakers, and I will just leave the stage to them just to go on with the webinar. So good afternoon, and Giovanni, Andrea, and please just go on with the webinar. And just
all right. Okay, thank
you. Now we can see you, and we can hear you. We can see your screen. Perfect.
All right. So here we are. Thank you very much, Carlo. Today, my colleague Andrea and I will present the investment process and the selection of business opportunities from an equity investor point of view. We start with what investors look for, the investors and their selection criteria, and then in the second part, Andrea will present the investment process and toolbox and some best practices. First of all, equity investors look for companies and businesses with particular characteristics that we grouped in 4 areas. In particular, market opportunity, value proposition, management team, and financials. Looking at the first one, equity investors are very interested in businesses with growing and reachable market, and with businesses with a unique selling proposition, which should be very well defined and sustainable in the market. Looking at the third point, the management team, so the human element, this is very important, and equity investors are looking for potential leaders in particular sector. So they're looking for solid management with high expertise. Then the last one, financial, the financial part, equity investors are looking for businesses with sustainable financials and potential high return on the investment. So the key elements are stage of development of the company and type of investor, because we are talking about investors from business angel that are interested in companies in their seed phases, and venture capital investors that are interested in later stages, such as startup financing and later stage venture capital. So, as I said before, the management team is a very important element, and the management team must be ready to talk to these equity investors and to explain them that people and the management team are ready to develop the business idea. Another important element is the pre-money evaluation that Andrea will explain you later. And the last element can be the business plan, because this is the tool that entrepreneur can use to present their own ideas to equity investors. With reference to business plan, we would like to highlight that a good business plan is not necessarily a good investment. When an investor say no, this means that this could be this is not linked to the business plan itself, but it's usually linked to the fact that the equity investor is not interested in a particular business idea. So the main driver of the project selection are players' affinity, which is linked to what I said 1 minute ago. So if an equity investor say no, usually one of the main element is that there's no affinity between the entrepreneur and his ideas and the player. Then the business model validity, that from an investment point of view is not okay, okay for the investor, and then the valuation. Then we decide to highlight two different elements, in particular the type of investors and the selection criteria. Looking at equity investors, and in particular business angels and venture capital players, as you can see, there are different selection criteria. For business angel, we tracked in the market that entrepreneurs matching the perceived trust and the personal relationship, and also the business plan quality and scalability, the management team, the market knowledge and the exit strategy are the main and the key elements of their selection. While looking at venture capital players, the key elements are a sustainable business plan, in particular with patented technology in most cases, a track record of the management team, a rapid business growth, so the possibility to grow very fast and a ROI increase, and as well as in the valuation made by business angels, also a strong management team. Those elements are combined also looking at the risk-return trade-off. In particular, if you look at business angel, the perceived risk is very high, such as the perceived potential return, while venture capitalists are, as you can see, are characterized by a high perceived risk and a lower perceived return. Anyway, we are talking about equity investors that are dealing with very high risk investments, and so the trade-off risk-return is in line with this element. In the end of this first part, I would like to summarize all the elements I told you before. Looking at the risk-return trade-off, and expected high return are one of the key elements, as well as the possibility to create value during the life of the investment that could be reached thanks to a market growth potential. In looking at, in particular, venture capitalist players, the exit strategy is a key element. so the possibility to sell their own share in the portfolio company after the 5-year investment is key for them. And before signing an investment agreement, this possibility should be analyzed very well. Then the management team, and so the human element is a key element in the selection criteria, and then of course, as I said before, also the product service uniqueness. Then we decided to add the business angel case in terms of investment criteria, and we would like to highlight that market growth potential and the management team are the two main key elements for a business angel in the selection process. Also, the expected return and the revenues and the exit strategy are very important, but not as much as market growth and expected returns. Then here we propose some data concerning the selection criteria. So on 100%, the management team can be weighted as the 30%, then the size of opportunity 25%, and the 15 is dedicated to product and technology, and then sales and so on. In the end of my presentation, I would like to introduce the deal flow, which is the process through the equity investor search the new opportunities, and it is influenced by the characteristic of each investor, the geographic area, and investment type. Usually, the equity investors have a strong network from which the deal flow can be originated. For example, for venture capital investor, in their network there can be universities, tech centers, and innovators active in the startup ecosystem. Before leaving the room to Andrea, the last element I would like to highlight and to present you is that is the business plan screening. Every year, venture capital investors receive around 1,000 business plans. So they have to analyze them in on different levels. And starting from 100 business plan received, in the end of their process, they usually invest in 2 or 3 companies. So after an initial screening, 50 projects has been selected, and after a deep analysis, they select 20 projects. Then in the end, after the due diligence, they have 10 projects selected, and then, as I said before, they usually close 2 or 3 investments. So the percentage of closed investments starting from 100 business plan is around 2 or 3%. Now, Andrea will present you the investment process, so I can leave the floor to Andrea. I thank you very much. Please, Andrea.
Okay. Good afternoon, everyone. Thanks for your attention. My name is Andrea Odille Bosio. I'm a Ph.D. student at LIUC, as well as a project manager for IBAN, the Italian Business Angel Network Association. So today I will be following up the presentation Giovanni just gave by introducing the last 2 points of our agenda. The first one being the investment process and also all the tools and instruments that are normally used and should be used throughout the process. And then follow the presentation of this, I will be presenting you the main methodologies of the company evaluation, as well as the key best practices that any startup or company owner should follow in order to achieve the best possible results out of an investment proposal. So let's start by assessing the 10 steps.
Andrea, can I just stop you just a moment? Just asking you to maybe to better fix your microphone, since before we could hear really well Giovanni, and now we had just, I think it's just a microphone. It's just as the way you keep your the way you keep your headphones.
Okay. Can you hear me now? Better?
Okay, better. Perfect. Thank
better?
you.
Okay. Sorry. Maybe I can try speak louder. So I was saying that we will start by reviewing the investment process 10 key steps. The first 3 of which were already touched upon by Giovanni. The first one being the preliminary analysis of the executive summary, which is basically a very, very brief introduction to the investor about the project. And then, well, there is the non-disclosure agreement, which nowadays is less used than in the past, because, as Giovanni told you, investors normally see many projects every day, and for them to sign for each one of them a non-disclosure agreement is becoming impossible and unfeasible. And then there is the business plan, which should be presented through a pitch by the investor, and then will be further discussed on between the parts if the project is liked by the investor. Then there is the initial deal evaluation. In this one, the company will be evaluated both from a pre-money, post-money standpoint, and then there is the initial, if the evaluation and the deal structuring goes well, there is the signing of an initial letter of intent by the investor, as well as the term sheet. After which we have the due diligence process, which I will further describe later on. And it's basically a process through which all the information necessary for the investment to happen are gathered. Then there is the finalization of the business plan after the due diligence and given the information gathered by the due diligence. And then finally you have the deal structure definition, which leads to the negotiation process between the two parts. And if the negotiation process goes through without any particular issue, you have the final signing of the investment agreement as well as the shareholder agreement. So in order to give you a time frame for the entire operation of investment, I will now present to you the business angel case. Obviously, if not, the timing for each operation is not the same for every type of investment. In the case of the business angels, they normally take less time than other type of investors, such as the venture capitalists. So these are very specific time frames, as well as an average of all the possible timing for each different business angel investor. So we start off with an average of 2 weeks for the initial screening of the project proposed by the founder. And then if this one succeeds, and the initial screening, as we saw before with Giovanni, is very tough. So if the founder succeeds in proposing his project, then there is the valuation, where, as I said before, normally there is not anymore the signing of the NDA, which is the non-disclosure agreement, but still the business plan is evaluated in detail and questioned by the investor, for then moving on, if this step again is successful, to a 3-4 week due diligence, where at the end of which the letter of intent and term sheet will be signed. Then there is the negotiation between the two parts regarding the company evaluation, the terms of the investment, and the possible exit. And at the end of this, the investment and shareholder agreement are set and signed. So then the investment happened, and as we will be seeing later on, the investment the happening of the investment is not always strictly connected to the overall investment amount being given, because the investment can happen in different tranches, but still the investment is happening. And from there on, there is the normal business angel investment period, which is between 3 and 5 years, depending on the conditions. And in this one, there is a constant monitoring from the investor. And this monitoring is based on the contractual milestones and clauses that were negotiated before, upon reaching which the investment can go through. And at the end of the established period, let's say 3 years, there is the final exit of the investor, which should be already set by the selling clauses that were negotiated again in the investment agreement. So then, what are the key tools and the key conditions that should be known by both the parts, both the investor and the founder, and should be agreed upon? Well, first of all, there is the business plan analysis, which Giovanni already explained. And this one, the business plan, is analyzed at a very initial, both at a very initial stage in the screening process, as well as later on in the negotiation. And then there is the due diligence. So the due diligence, first of all, is not an audit process. Is just gathering of information, not binding, necessary to decide whether to invest or not from the investor. And thereafter, in the post-investment, the milestones will be based on this due diligence process. So in the due diligence, you gather the information that you will need for both deciding to invest, as well as deciding the milestones you should put in the contract. The due diligence covers several areas, among which I can list the business due diligence, financial, asset, human resources, fiscal. Nowadays, the environmental due diligence is very important. Then there is the legal, the accounting, and so on and so forth. The key feature the investor will look for in a due diligence are the potential deal breaker situations and indicators, as well as some hidden value, which should be searched by both the investor and the founder, and the sustainable profitability. The investor will try to assess and verify the sustainable profitability of the target company. As well as they will define the net financial position of the company and assess the net working capital. So normally the due diligence is done by a third party, which is not involved in the process. Then typical structure of investment may be based on different tranches, meaning that the invested amount won't be provided to the company in just one lump sum investment tranche, but in several over the time of the investment, and it will be conditional to the reaching of some of the milestones we already talked about. So what are the reasons for deciding to go for a tranche-based investment plan? Well, it greatly reduces the operational risks for the investor from an operational standpoint, and as well as it is an instrument to focus on the business plan accomplishment, and therefore it is intended to bind the startup or the company to follow this business plan or to negotiate any further changes. Then there is the syndication. So the syndications, the syndicated investments are investments in which the investor is not only one, but there may be a network of business angels or some different types of investor which invest along with the main investor. And this is normally, it's a common practice done for diversifying the risk and the portfolio of the investors by lowering the ticket for each one of them, the enter ticket, which is the amount of money invested, as well as signaling to other investors about the quality of the investment done, and also gives legitimations to the company. And then it also helps the follow-on of further investments and facilitates the networking process between investors and the company. Then there are the anti-dilution provisions. These provisions are mostly related to or important for the investor, and the main purpose of these provisions, contractual provisions, is to avoid protect the stock owned by the investor by restricting or shielding the investor from later stock issues to other investors. Then there is the corporate governance, and this is a broader term. It implies, it defines any system of rules, practices, and processes to which a firm is directed and controlled. And normally the key element of the corporate governance imposed by the investor is the board of directors, as well as some veto rights and quorums to be had before certain decisions are taken, which will be negotiated in the investment process, in the negotiation process before the investment. And this is all done to protect the investor, given the fact that normally an investor will own a minority stake in the company. Henceforth, the founder will stay and be the majority owner. And the reason why normally the investor wants to be a minority owner is to further induce and stimulate the founder to take ownership of the startup and perform at his best. And then finally there are the exit clauses. So these are negotiated as we saw at the start of the entire investment process and are already established by negotiation between the investor and the founder. The most common clause among the exit clauses is the liquidation preferences, which imposes a payout order in case of corporate liquidation, which is the worst case scenario. Then we move on from the investment process toolbox for main operations to the company valuation. So the company valuation, first of all, during an investment negotiation, can refer to two different values. The first one is the pre-money value, and the second one is the post-money value. The pre-money value, as you can see here, refers to the value of the shares owned by the company founder, which is also the seller, who is also the seller, before the investment, whilst the post-money valuation refers to the debt initial amount, so the pre-money valuation, which is recognized by the investor to the founder, as well as the sum of all the investments, so the amount of money the investor will put in the company. So it's the sum between these two values. Here we have a graphical representation of the company valuation, and as well as a step-by-step calculation of it. And then we have to recall that given the contractual clauses we talked about before, the percent the shareholder, the investor holds is not relevant in determining the governance structure, because as we saw before, the investor protects himself from being a minority owner. But still it represents the quota that the investor recognized to be given to the initial founder, as well as it's related to the invested amount of money that the investor gives. Then how do we define the company valuation, meaning the pre-money valuation? Well, there are different ways to do so. Here I reported the most common ones, and these methodologies are prevalent in one or the cases depending on the company lifestyle phase. So a company in a maturity phase may be using more the cash flow analysis than the others, whilst, for example, the startups normally use the venture capital method. So these methodologies have some strong assumptions, so are modeled around some assumptions and fit best in different life cycle phases of a company. Regardless, the three methodologies I present to you today are the cash flow analysis, the market multiple calculation, as well as the venture capital method, which is a method that obviously is strictly related to the startup case. And then we have also to assess the fact that these calculations are models that are applied and are based on, as I said, assumptions. So thereafter, after you get a value, you have always to make adjustments to that value, given the specific situations you may find yourself into. So the investor will take into consideration, for example, the investments an owner made beforehand, as well as the market readiness, if there is already a prototype in the startup or some patent, as well as some unique selling points or a competitive advantage that the owner may have produced. And then also, of course, the goodwill infrastructure will be recognized. So the methodologies I'm going to present you will give you a number, but then you have to make adjustments to that number on the basis of the specific situation you find yourself facing. From a conceptual standpoint, we can divide the model I just spoke about in two different categories: the indirect or analytical methodologies, as well as on the other hand, the direct and market-related methodologies. The first one is based on indicators, so you will search for numbers in the balance sheet, in the income statement, and the cash flow statement. So the analytical method focuses on economical and financial values to calculate the value of the company, while on the other hand, the direct or market-based methods are focused on trying to find some comparable transaction or create a multiple based on some comparable values, such as the EBITDA or the revenue, and then try to find the value of the company. So in one case, you don't focus on the markets, you just focus on the company values. In the other one, you focus on the market and you try to find a value which comes from an ask bid or buy and sell relationship, negotiation better. So then if we look at the startup valuation, we can see that there are some issues in it, being that the startup has no track record, no previous revenues or balance sheets you can base your analysis to, and then a strong dependence on the private capital. It's further skewed the leverage towards the private capital, and then high risk. So these factors eventually lead to an issue in assessing the company value, which is the fact that most of the times you have a lack of comparables because you don't have a track record to base your choice of the comparables onto. And then you have some issues related to the presence of different shareholders that there may be, and shareholder rights, mostly if it's not the first round of investment in that company. Then you have hard time assessing the weighted average cost of capital, being the fact that you have a strong dependence of private capital, low investment liquidity, infeasibility to forecast, and the existing assets are just a very small part of the overall potential of the startup. So given these, normally the first two methodologies, which are the cash flow analysis as well as the market multiples, are not feasible, being that the first one is based on forecasting the cash flows of the company in the future years on the basis of the previous year's cash flows, and then actualizing them, which cannot be done in this case. And in the other case, the market multiple method, you are searching for comparables, and you have to create a comparables pool through which you will find the value multiplier for, in many cases, the EBITDA of the startup. And in this case, you may have a hard time finding relevant comparables in the market, which eventually had also an operation like an investment or a selling of shares. So then the only method you can use is the venture capital one. And this one is based on end to start process. So you basically invert the process to which you would calculate the value of the company. Therefore, you start by forecasting on the basis of some strong assumption the exit value that the investor requires or expects to have after the investment. And from that assumption of value, you eventually work your way back by actualizing that value using as a discount factor the ERR that the investor normally would have, which is between 25 and 60%. And then so you calculate the startup value, the actual startup value, starting from the exit value and actualizing it by discounting to the ERR factor. And finally, you divide that value on the basis of the acquired share that the investor wants to have, or better, you divide the value, you divide the investment value, so the amount of money the investment provides, by the value of the startup, and then you find the acquired share. Or you can do it the other way around to find the investment value. So finally, the last step in an investment is the exit. And as we said before, normally the exit is established through the negotiation, the initial negotiation, so before the investment is done. And you basically, what the investor wants is a capital gain, it's for a return on investment through the sale of his shares And this has two different impacts on the investor. The first one, for example, for the business angels, he can reinvest in new opportunities of investment, and for the venture capitalist, normally he distributes back the capital gain to the limited partners and the investors henceforth in the fund. What are, for the startups, the options that are given by the investor? Well, normally you may have a normal shares sale of the shares to new investors, which will eventually finance a new round, as well as the buyback process, to which the shares are sold back to the founder. Then there is possibly the best case scenario where the company goes public and there is an initial public offer, or you can have a trade sale scenario. These choices are, let's say, are made before the investment is done and are based on several possible scenarios of the overall investment process and the ongoing business of the startup. So then I will end this presentation by talking about some best practices for the entrepreneurs that would like to receive some capital from an investor. And these are based on the experience of the IBAN, so the Italian Business Angel Network, as well as the literature, academic literature. So first of all, the entrepreneur should always plan in a 5 years period, at least, given the fact that this is the more or less average, between 3 and 5 years it is. So it is the average investment period, so the investor will eventually always try to assess what will be the condition of the company at the end of the investment. So it's good for an entrepreneur to prepare himself with this kind of planning. Always provide financial information and forecastings which are needed for the investor to make any kind of assessment related to the company. Obviously, the leverage should be kept low in initial stage for a company, and it is important to have a balanced financial structure throughout the life of the company. And this is particularly important when you ask for an investment, given the fact that the investment itself will change the financial structure of the company itself. And then always make specific investment proposals, be ready with a business plan, and be ready with a specific project that you want to pursue, which may ease in the process of evaluation and forecast for the investor, given the financial information and the project itself. And then, obviously, the forecast has to be realistic, and the more realistic, the better. So the investor will always ask for conservative forecasting, and it's useless to start by having the best case scenario and nothing else in your forecast. And then always disclose your guesses and the assumptions you're making in the process, in the project, because eventually those will be assessed in the due diligence process. Finally, some big mistakes to avoid. Always try to be conservative, as I said, in your proposals. You have to, of course, show an interesting project, but you don't want to be overly confident and overly optimistic about the result of the project. So don't give no realistic projections and don't try to embellish the numbers. And finally, for the presentation itself of the project to the investor, try to tailor the presentation to the investor you face. So different investors, such as business angels or venture capital, have different investment philosophies, and you should be trying to find what the investor is looking for and try to tailor your project and the presentation of the project to their liking. And then don't focus too much on the PowerPoints, because as Giovanni told you, one of the most relevant factors in analyzing or in assessing an investment is the team itself. So the team has to be able to present the project without any kind of presentation or any kind of further material. The team itself should be able to take their own presentation by themselves. So this is everything. If there are questions or if there is anything, we are here to answer.